This is for Chapter 9. It's Part 1, Additional Inventory Issues, Valuing Inventory at Lower of Cost or Market, and the Gross Profit Method. Now, your inventory can lose value over time because of various things such as damage, obsolescence, and what it does is it reduces your ability to sell it, and GAAP likes inventory to be shown at what you can actually sell it. So we have two methods we like to use. We can use the lower of cost or net realizable value, and that's for FIFO. It's everything except LIFO or retail inventory method. And then we use lower of cost or market for LIFO or retail inventory method. So let's go through an example. So here we're doing net realizable value, and we have our costs, and we're doing it by line item, and we have product 101. We have it on our books for 120, but the net realizable value is only 100,000, so that's what we have to use. For product 102, our net realizable value is higher, so we got to use the cost. For product 103, it's going to be our net realizable value, and for product 104, it's going to be our cost. Now we're going to add that up. And if you notice, there's a difference between our cost and what the inventory should be valued at, which means we're going to have to write it down by 30,000 and increase cost of goods sold and reduce inventory. Now, what if we had done it in total? Well, if we'd done it in total, we would not write it down because our costs are less than our total net realizable value. Now, lower of cost or market. This approach begins with replacement costs, then applies two additional limitations to valuing ending inventory. So we have a ceiling, which is sales price minus the cost to get rid of it. And the floor is that ceiling less a normal profit margin. So what you have to do is net realizable value. What do we want to do? Replacement cost has to fall within the range. It has to be less than the ceiling and more than the floor, or equal to. So let's take a look at an example. Let's first determine the ceiling. So first we're going to take the cost, and then we're going to subtract the completion and disposal cost. And that gives us $9. So that means that we cannot have the value be higher than $9. The floor, we're going to take the ceiling and we're going to subtract from that the profit margin. So that means it has to fall within that range. So our designated market of $8.40 falls within the range of $9 and $7.20. So that would be our designated market of $8.40. So now let's look at all the items. We start with the selling price, we reduce it by the disposal costs, and that gives us our ceiling. We then take away the profit, and that gives us our floor. Now we're going to determine the designated market. We're going to look at the replacement cost and see, does it fall within the range? For product A, it does, so we use the $8.40. For product B, it does, so we're going to use that. For product C, it does not, so we have to use the floor. For product D, it does, so we're going to use that. But for product E, it's too high, so we have to use the ceiling. Now we can go through and do our comparison of lower cost or market. We have our designated market and we have our cost. So in this case, we would use our cost. For B, we would use designated market. For C, we'd use designated market. For D, we'd use our cost. And for E, we'd use our designated market. Less our cost, which is what's on the books, And that tells us how much we have to write off per unit times the number of units gives us our total write-down. Now, when we record it, we have two ways that we can do this. We can use the cost of goods sold method, which means we're just going to take it to the cost of goods sold and reduce inventory. Or we can use the loss method. We'd only use this if it's a substantial write-off. Let me show you those journal entries. Okay, if it's not unusual, it would just be cost of goods sold would go up, inventory would go down. If it's substantial, you'd have a line item under other called loss due to market decline of inventory. And then we would also reduce our inventory. Now, for lower of cost or net realizable value, under GAAP, we cannot reverse. If we write it down, it goes back up. And we can apply it by item, by category, or the entire inventory. Under the international standard, there are circumstances where you can reverse your write-down. And for them, for looking at it, you can look at it individually or sometime in groups, but not in total. Now let's look at the gross profit method. Now, gross profit method, also known as gross margin, and we use it whenever we have to estimate ending inventory, and this would be if we're doing periodic, because we don't know what our cost of goods sold and ending inventory are until the end, and we have to do a physical inventory, but this is in the case where you can't or you don't want to. Like, for instance, if an auditor is doing a test or you're doing interim reporting. Now, normally, this is how you determine it, but with the gross profit method, you're starting with beginning inventory plus purchases minus estimated cost of goods sold gives you estimated ending inventory. Now, gross profit percentage, they can give it to you two ways. Sometimes they give you the gross profit percentage, or they give you gross profit on costs, and you need to convert. And the way you do that is you take the markup on costs and divide it by 1 plus the markup on costs, which will give you the gross profit percentage. So if you're given 25% gross profit on costs, it's 20% gross profit on sales. Now, here's the formula for coming up with estimated ending inventory. You start with all your inventory plus all your purchases adjusted by any returns or discounts. Then you're going to get your total cost of goods available for sale, and then you're going to subtract out your estimated cost of goods sold, which is going to be net sales minus sales times gross profit. Let's take a look at an example. Here's our example. We start with our beginning inventory plus our net purchases gives us total goods available for sale. Now we have to subtract out our cost of goods sold. We take our net sales times our minus our gross profit, but we're going to take our net sales times our gross profit percentage and subtract that out, which gives us estimated cost of goods sold, which gives us estimated ending inventory, and then you take out your theft. And that gives us our estimated ending inventory. Now, what happens if instead they gave you markup? Well, what we have to do again is our formula. We're going to take our markup divided by 1 plus the market. It gives you our gross margin. And now we're going to do our same calculations again. And that would be what our ending inventory would look like. And that concludes this part 1 of this presentation.